So let's calculate the EV EBITDA. An associate has gathered the following data from Megasoft. Recent share price is $10. Shares outstanding, market value of debt, cash and short-term securities, investments, net income, interest expense, depreciation and amortization and taxes are all given. Based on this information, calculate the EV EBITDA ratio for Megasoft. So first let's calculate the enterprise value. Enterprise value will be the market value of equity. That will be $10 per share into 50 million shares, that is $500 million. That is equity value. Then we'll calculate the value of the debt, which is given to be $100 million, minus the value of cash and short-term investments. So there's cash of 20 and investments of $80 million. So minus $100 million of cash and short-term investments, which will give us the enterprise value as $500 million. Now, the EBITDA can similarly be calculated. So, sales minus gross profit and operating expenses gives us EBITDA, minus depreciation gives us EBIT, minus interest gives us EBT, minus tax gives us profit after tax or net income. So to the net income, I need to add back the tax, I need to add back the interest, and I need to add back the depreciation to get to the EBITDA. So the net income is given to be 150. The taxes paid are given to be 50. The interest expense is given to be 10. The depreciation is given to be 40, which will give us the EBITDA as $250 million, or the EV EBITDA ratio comes out to be 500 divided by 250 as 2 times. Please note that using relative valuation methods that require the use of comparable firms can be challenging in an international context. So if our comparables are coming from different countries, then we must definitely account for the differences in accounting methods, cultures, risk and growth opportunities. Please note that the EV EBITDA multiple is used in a similar way than any other multiple. So we compare the multiple to the peer median, to the average and to other companies and other industries to decide whether the company is undervalued or overvalued. Now the last concept in price multiples tries to tell us how to calculate the price earnings ratio for an index. Please note that if there are many stocks, like say there is stock 1 with an earnings expectation of $2 and a price per share of $20. And there's another stock with an earnings expectation of $5 and a price per share of $100. So the P by E ratio of stock 1 will come out to be 10 times. The P by E ratio of stock 2 will come out to be 20 times. If we compute the P by E for the index, then let's assume that this is all what our index was. Both stocks are an equal weight. Then, or 1 share of each. Then the earnings expected from the index are 5 plus 2, $7, and the price of the index would be 100 plus 20, $120. So if we pay $120, we are expecting an earnings of $7. So the P by E multiple for the index is 120 divided by 7, that is equal to 17.14. Please note, if we just took an average of the individual stocks, then the multiple would have come out to be 15, which is the wrong answer. So the P by E multiple should either be calculated like this, that is, sum up the price of the index divided by the earnings expected from the index, or we can calculate the weighted average harmonic mean, that is 1 upon the weight of stock I upon the PE multiple of stock I plus weight of stock 2 upon the PE multiple of stock 2, so on and so forth. Let's see if this gives us the correct answer. It should come out to be 17.14. So 1 divided by weight of stock 1 in the index is 20 upon 120, because the total
On the basis of price.
yeah, value weighted. So the total value of the index is 120, stock 1 is 20 and stock 2 is 100. So weight of stock 1 is 20 upon 120 divided by the P by E multiple of stock 1 is 10 times, plus weight of stock 2 is 100 upon 120 divided by the weight or the PE multiple of stock 2 is 20 times. So please verify that this will come out to be 17.14, that is the same as the price of the index upon the earnings of the index. If we even did a weighted average of the individual P's, that is 20 upon 120 into 10 plus 100 upon 120 into 20, then the answer would have come out to be 18.33. Please again, even this is not the correct answer. So to calculate the PE for an index, either you actually sum up the total price you are paying upon the total earnings that you are expecting, or you do a weighted average harmonic mean. So that was about the review on price and market multiples. A very important topic, a lot of new concepts and new ways of looking at equities presented. So please make sure that you practice a lot of questions, use your question bank a lot, and you're confident about each aspect of the chapter. Thank you and see you next time.